We've got an earnings alert on Alphabet. The stock is lower in the after-hour session despite beating expectations. Let's get to Josh Lipton in San Francisco with the very latest from the conference call. Hey, Josh.
So, Matt, one focus on the call is clearly Google's capital expenditures. You saw CapEx just shooting higher in the quarter to about $6.8 billion. That was higher than the street was looking for. Here's CFO Ruth Porat talking about that on the call. Take a listen.
With respect to CapEx, we continue to invest in both compute requirements and for office facilities, although we expect the CapEx growth rate in 2019 to moderate quite significantly.
CEO Sundar Pichai was also on the call with more color about those investments. New and expanded office space he talked about. Of course, you guys have that new campus there in NYC. Talked about data center construction and expansion, called that an important long-term expansion. Also did give some color about different business units and segments. Talked about YouTube. Said the number of YouTube channels with more than 1 million subscribers nearly doubled in the last year. Said the number of creators earning 5 or 6 figures grew by more than 40% year over year, but no big dramatic breakout of YouTube, the kind that we know some on the street would like to see. Same kind of goes for the cloud business. Sundar Pichai saying it's fast growing, said it was a multi-billion-dollar business, said last year they more than doubled the number of Google Cloud Platform deals, over 1 million, but no revenue run rate breaking out there, even though analysts did press him on more stats and facts there, though Porat calling it one of the company's fastest growing businesses. Of course, we know that business also has a new chief. Remember Thomas Kurian coming over from Oracle. He's taken over that business from Diane Green. Mel, back to you.
All right, Josh, thanks. Josh Lipton in San Francisco. For more on Alphabet earnings, let's bring in Fast Money friend and Loup Ventures founder Gene Munster on the fast line. Gene, what do you make of the results? I mean, it's interesting because it seems like for a lot of these big cap tech companies, it's all about spending. If they're spending more than what investors expect, that really seems to put a damper on the movement of the stock.
Yeah, Melissa, this call had a subtle tone of confusion from analysts that I can't really recall from other calls, but it was to your exact point. It was related to expenses. So essentially there's a mixed message coming from the company. On one side, you have them saying that they're going to spend more on cloud hardware, traffic acquisition, as mobile, which carries a higher cost of acquisition, becomes the growth driver. And so that's a negative, and that's investing more. On the other side, to Josh's point and some of the soundbite that he had, is they expect CapEx and hiring growth rate to materially slow this year, which is positive for earnings. And so I think it's been this, there have been a few analysts have asked, just trying to get some clarity, and the company keeps reiterating these 2 points. I suspect the bottom line is investors don't like hearing about investment because we're in a period where investors like profitability, but those investments are really important for the long term. So I think that the net of this quarter was very positive.
Hey, Gene, it's Dan. You know, last year, obviously, when Facebook told us that they are going to be spending more for a whole host of reasons, obviously earnings expectations for 19 got destroyed, and so did the stock. Here I'm looking at Google now, and it was one that we used to say on a PEG basis, a PE to growth, looked pretty fair, even at about 20 times. Now earnings estimates are coming down for 2019 in mid-single digits, and the stock's trading 24 times. Is this when we kind of lose that PE to growth for Google in the near term, or Alphabet?
I don't think so. I think this is going to generally stay in favor, in part because of the stability around this business. I just want to emphasize that. And that's different than some of the uncertainty around where Facebook's revenue growth ultimately is going to be, or what Amazon's investment cycle looks like. So Google grew 22%. That's the same growth rate they've had over the past 3 years. Really incredible to see that kind of stability. Now, there's going to be some wavering in that growth rate based on timing of new products that they talked about. But I think the key is this, Google is the oxygen of the Internet. We cannot live without it. And I think if you look at things like Facebook and Netflix, we potentially could live. There's other kind of services that we could supplement for those. So I think that, in this case, this is a kind of a different type of conclusion here. And I think the conclusion is pretty straightforward, is that Google is going to be a long-term winner. They have an AI-first approach, which will make their products better and be positive for revenue growth for the long term.
I get what you're saying, Gene, but I mean, on a multiple basis, it doesn't trade like it's the must-have thing going forward. I mean, if you're saying we can do without Facebook and Netflix. They have a much higher multiple. How do we think about Alphabet, and when does that premium get into the stock if you really say that it's the lifeblood of the internet?
So there's a little bit of effect where they're just not getting the proper credit. I think Apple is probably the best example of not getting credit. I think Google is probably the second best example. And it's always hard to predict when investors will fully realize and appreciate that. I think that if you look at the roadmap of how investors generally think, there's some skittishness about expenses, but they also want to see revenue growth. So simply to answer your question is what could get this multiple to re-rate higher? Unfortunately, it probably needs to come from some other events and their other bets. What's going on with Waymo or Verily, their healthcare initiatives. I think those type of things, and just to kind of put Waymo into perspective, is I'm not endorsing these numbers, but some analysts think that business could be worth $100 to $150 billion. So if you take the high end of that, that could add 20% to Google's overall business here. And so these are massive opportunities that the company has longer term. And I think as investors have a hint that there's something exciting around the story in terms of revenue growth, that should be positive for the multiple.
What's your grade on the quarter, Gene?
So we're giving it a B plus, and I think that revenue growth continues to be favorable. Expenses, some confusion, but this is the oxygen of the internet, and it's one that investors should own.
All right, Gene, thanks so much for phoning in with your analysis. We appreciate it. It's always good to hear from you.
Thank you.
Gene Munster of Loup Ventures. I feel like we go through this with a lot of these names. They say that they're going to spend more, and then the stock goes lower. We saw that with Amazon. We saw Facebook have the opposite reaction because they had a handle on expenses.
Right. So if mobile is their growth strategy and the margins are going to be smaller in mobile, then that's the first problem. CapEx, and when Gene said that they're the oxygen, there's a couple of players that are stealing the oxygen from them. So it's
search?
Facebook and it's Amazon. No, ads. Okay. So now it's Facebook, it's Amazon. So there's a lot of people where they used to be the only guy at the table or the gorilla in the room. Now there's a couple of other gorillas in the room that are stealing oxygen from them. So I would wait till a little bit of this smoke clears. Waymo is not enough of a driver right now. That could be the one, as he said, to re-rate the multiple.
I mean, look, there are things that are, in a way, timely at any given moment in the market, and there are things that are maybe dull. Frankly, the stock is dull here. It's had a recovery. It's not indicated well tomorrow, nor is it indicated that poorly. The truth is, it probably belongs here. Sometimes stocks are fairly priced. I think that's the case with Goog.
I mean, it has been dull for a while.
It has, yeah, but I still think it is a great long-term stock. I still think it is the biggest gorilla in the room when it comes to digital advertising. As a business owner myself, I've tried Facebook, I've tried some of these other platforms, and just none of them are as effective as Google's. I mean, you can spam people in their Facebook news feed, or you can actually get qualified people to come to you through Google. So, I think when it all boils down to how effective the company is, I think they're just head and shoulders better than their peers.
Well, I think the bigger thing relative to its peers is that it's very diversified, specifically to Facebook. They have about 7 platforms that with like over 1 billion users. Now, obviously, a lot of that is based on selling ads, but there's a lot of other drivers there. We're not going to know what Waymo means for this valuation for a very long time, but I think it's one of those reasons. People didn't like the other bets. Remember that? Like 5 years ago, it was kind of in the box for that sort of thing. Well, now they have another bet that is the size of many Fortune 100 companies, at least in market value within it. So to me, I think that, again, if you have a longer term time horizon, it's likely you're going to see the stock back at 1,000 sometime in 2019, but it's likely to be higher in a few years.